For the first question, what is the primary objective of financial reporting? The main goal of financial reporting is to give useful information to investors, lenders, and stakeholders or any other users. It helps them understand a company's financial position, performance, and the cash flow. Good financial reporting makes sure that information is clear, comparable, and trustworthy. This helps people make better financial decisions. So for next question, how does physical representation differ from relevance as a qualitative characteristic? Relevance means the information is useful for decision making. It helps predict future outcomes or confirm past decisions. Faithful representation means the information is true, complete, and free from major errors. The difference is that relevance focuses on how helpful the information is, while faithful representation makes sure the information is accurate and reliable. For the third one, what does the convention of consistency require and why is it important? The consistency principle means a company should use the same accounting methods every year. If it changes methods, it must explain why. Consistency is important because it helps users compare financial statements over time. It makes financial reports more reliable and easier to understand.
First, the full disclosure principle ensures that companies provide all relevant financial information in their statements and notes. This is crucial for transparency, allowing investors and creditors to make informed decisions. For example, if a company is facing a lawsuit, it must disclose this information even if the outcome is uncertain. Next, we have the principle of the conservatism, which requires accountants to be cautious when recognizing revenues and expenses. This means that expenses and liabilities should be recorded as soon as they are foreseeable, while revenues should only be recorded when they are certain. For instance, if a company expects a loss from a lawsuit, it should report it immediately. However, if it expects gain, it should wait until the gain is realized.
Okay, let's just see these interesting cases from Agency Hands 2022 income statement. And I'd like to answer the first question. And you can just look at this income statement. It's obviously it can show that in 2022, agency recorded 455 million ringgit in revenue, which is nearly three times more than the previous year. It sounds great, but there's still a twist. They also reported a net loss of 135 million ringgit. So what happened? Uh, well, the main reason was the massive spike in operating expenses. It was over 252 million compared to just 11.9 million ringgit before. That's more than 20 times higher. Also, they made some no-cash impairment adjustments. In simple terms, management re-evaluated the value of certain assets like receivables and goodwill and decided that they probably won't get the full value back. So they had to write it off, and that dragged down profit even though it wasn't actual cash going out. Let's go to the second question. Uh, if the second question is if the dirt drop down, if cost of goods sold increases but revenue stays the same, what does it say about operational efficiency? Obviously, if the cost of goods sold increases significantly while revenue stays the same, it means the company is being less efficient operationally. Maybe materials or labor costs have gone up, or there's a wastage, delays, or a weak project management. And if you can't pass those extra costs to customer, Maybe because the market is too competitive, your profit margin shrinks first. And the last question is is what can agency do to improve their gross profit margin? Well, a few ideas I will give in the below. The first, they could optimize procurement, negotiate better deals with suppliers, and so on. Second, use more efficient construction methods like the industrial trailed building system, which can lower labor costs and speed up no competition. Third, they may focus on higher margin projects and avoid no profit contracts. And finally, they could add more value to their services by offering better design, uh, such as take integration or faster delivery, and then charge more for it. So, in conclusion, I think agency's case is a profile perfect reminder that revenue growth doesn't guarantee profit. Without good cost control and smart strategy, then even a growing company can end up losing money. Okay, so that's all for my part.
Hello, doctor. So let me answer the first question of the balance sheet analysis. According to the Edison Burkett 2022 financial report, the company's current liabilities are higher than its current assets, which may lead to insufficient short-term debt repayment ability and increased liquidity risk. And if short-term debt cannot repay in time, the company may face the risk of declining supplier credit, increased financing difficulty, and cash flow depletion. If the financial situation cannot be improved quickly, the company may need to rely on additional financing and assets monetization to maintain operations, which will affect the long-term development. And for the second question, according to the 2022 financial report, Edison Burkett has a high debt to equity ratio, indicating that the company is heavily dependent on debt, increasing financial leverage risk. High debt levels means increased interest expenses, weakened profitability, and may face a greater financial pressure when the economic environment deteriorates. And the decreased confidence among the investors and creditors may lead to higher financing costs for the company, further exacerbating financial instability.
To address liquidity issues as indicated in Hudson Behan's 2022 annual report, the company should first prioritize effective cash flow management by actively managing receivables and ensuring timely collections. This proactive approach can significantly enhance cash availability. Additionally, optimizing and disposing of the non-core or effective assets can generate immediate cash inflows, or alleviating short-term liquidity constraints and strengthening the overall financial position. Debt restructuring is also crucial. Negotiating more favorable repayment repayment terms or extending the maturity of the existing debates can reduce immediate cash outflows and provide financial breathing space. Finally, the company should continuous pursue operational efficiency improvements, including adopting strict cost controls and effective efficiency working capital management, ensuring long-term sustainability and financial resilience.
How can an increasing liability position signal financial instability for a Janssen? An increasing liability position, particularly if not matched by a corresponding growth in assets or earnings, may indicate that a Janssen is accumulating debt to cover operational shortfalls. This can signal financial instability as it reduces the company's net asset value and increases financial risk. Why is monitoring cash flow from operations more critical than focusing on financing cash flow in the long run? Cash flow from operations is a better indicator of a company's ability to sustain its core business and generate profits. Over-reliance on financing to cover operational needs is unsustainable long-term, as it increases financial costs and risk. For Janssen, operational cash flow is critical to maintaining business opportunity.
At 2022 annual reports, when faced with declining the profitability ratios, the company should focus on the diversifying its business to include industries providing recurrent income, such as retail. Additionally, it is crucial to enhance cost management through the adoption of industrialized building system (IBS), improved procurement, and optimized supply chain operations to increase efficiency and reduce costs. Strategical assistant management is another essential measure involving regular impairment assessments and potential restructuring or disposal of underperforming assets, thereby ensuring the balance sheet remains robust and reflective of the true value. Lastly, embracing innovation and digitalization, specifically through the IoT and BIM technologies, will significantly enhance productivity, minimize operational costs, and reduce um, dependency on the manual labor. Positioning Anderson beheads for the sustainable growth in challenging market condition. Okay, final our presentation.